is a word called liquidity. Because it's a skinny market, right? Gold is, when we talk about the majors in terms of futures trading, we're talking about obviously the ES, we're talking about the ZB, we're talking about the ZN, obviously most of the bonds, the ZF, for example, we're talking about oil, we're talking about the CL contracts. These are the major contracts. Now, there's obviously big contracts elsewhere. The copper's a relatively meaty contract, soybeans, pretty good contract. Some of the other ags, pretty good contracts in terms of meat. And obviously some of the Forex markets are pretty good meaty contracts. The pound, the Japanese yen, the euro. But we're not talking about the main volumes. Gold is not one of those meaty contracts. It is pretty skinny in terms of, it's got great volumes, but it is, for the most part, a relatively skinny contract for commercials to deal in. Certainly better than ultra bonds. It's definitely better than ultra bonds by a country mile. So one of the key aspects is getting liquidity. So one of the things that we don't do very often in gold is show our hand. We don't show our hand very often, because if we show our hand, everybody just snaps up the, I mean, God forbid that Nessie ever traded gold. She'd be front running every single time you saw a big sell coming in, and she would say, right, I'm in. And she starts selling 2 ticks before that sell off, right? So, you know, we've got to try and understand that. So a lot of what we do in gold is going to be what we would call, very simply, icing the order. We're going to ice the order. So what does icing the order mean? That means very simply that we hide the real size. We're going to hide the real size behind the order itself. So in other words, what we're going to try and do is we're going to try and do a refreshed order book as the price trades to our level. Now, if you've traded using MZ Pack or David's process or Greg's process, you'll understand the concept of refreshed order books. You'll understand the concept of Voltics. You'll understand these. One of the other things you'll probably also understand is that inside the MZ Pack, and I'm pretty sure it's the MZ Pack that's got this. I don't know if David and David and Greg's have got this, but you've actually got an ICE indicator, which is a pink dotted box. Yes, a pink dotted box around a red area, around a red filler inside here, or a pink dotted box around a green filler. And that's obviously what we would then understand to be an iced order. We would understand that to be an iced order. So in other words, when you see those iced orders, you're going to work into that as a short play. And when you see an iced order on the downside, you're going to work around that as a possible long play there. So these iced orders are very, very important. So one of the things you start looking for at extremes, you know, these are the ideas at extremes, because you don't want to frighten away the buyers at those higher prices. So you want to ice the higher price. You want to ice the lower price. So when you start looking for those ice orders to help you with your analysis, do you see the ice orders? The pink dotted boxes. Well, you can see there's no ice orders through this phase here. It's green, it's green, it's green, it's green, it's red, it's green, it's green, it's red, it's green. And then all of a sudden you get these two pink bottom edges here with a very, very substantial hidden order flow behind it. Hidden order flow behind it. There's your big opportunity to buy some possible institutional longs into that gold squeeze higher. When we come up into the top edge, do you see the ice order at the very top edge here? It's a pink dotted line around the green candle. So when we see that pink dotted line against the top green candle there, if you're interested in the sell, that's a very strong signal for the gold market in particular. For the gold market in particular, because they have to ice orders. The only way we can trade gold is to be icing orders, because otherwise people will just jump it. People will just jump in front, and that was the olden days when there was no algorithms that did ice orders. So obviously that's why they were invented, was because everybody was simply front running this exposure of liquidity. And the big boys are saying, look, we're getting screwed rotten here. So if you want us to keep providing liquidity, and they're saying this to the exchanges, if you want us to keep providing liquidity from the commercial side of the book here, we've got to have something to be able to hide our orders. You might say it's unfair, but that's simply the truth of it. If I put a big 5,000 lot sell in a market, the chances are if I put it in the market and it's visible and everybody knows it's real, I'm never going to get filled 5,000 contracts. I'm going to get filled 5 contracts. And I'm never going to be successful. Never. So obviously when you see those big ICE orders appearing on something like gold, you start really, really paying attention to them because, well, they mean something. They mean something. Not always, but obviously when they come out in line with what we're expecting or anticipating, then of course they really do mean something a lot more significant. Now, as I said, usually you'll see other ones. I mean, there's plenty of pink candles in here. There's plenty of pink boxes, but they're not at extreme prices. You can see there's a little pink candle there. It's not at extreme prices, you know, so you're not going to get the same kind of feeling about what's going on in this area. You're not going to get the same kind of concept of it. It should be visible, guys. That's all I'm saying. Should be visible. Got a little possible max bottom edge there developing on equities. It was on a downtick, so we were obviously very passive. Remember, when we're watching max, there's a couple of things you need to understand about max itself. When we get this solid green, what we're looking for is the red line to rise before we start buying it. Okay, so the red line has to be rising. If the red line rises and we are seeing that the top line is red, which it nearly always will be, which is why we managed to hold away from buying on a downtrend, this is what we've got to try and understand here. This is what we've got to try and understand here. Passive, 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 passive bidding into this, passing bid into this, passive bidding. So you can see on this drop here, Max has a look at this as a possible buy trade here. You can see the red line still declining, so Max isn't interested. Max isn't interested until that starts turning back up. Then Max might come in as a passive buyer. And you can see that by the time we get to this point, you can see that we're starting to see a strong line higher. We've got 4 solid Max triggers here. So we start bidding into the bottom edges. And you can see with a drawdown of just 1 tick, we end up with a very reasonable scalp profit on that little bit of an upside. It's pretty good, isn't it? It's pretty good. And you can see we've had a very nice ride north, a very nice ride north. And that's turned out to be a pretty good trade, guys. That's turned out to be a pretty good trade. We were right about that gold, by the way, at 1694s. It's got jammed at that price. That exhaustion print into that bullish order block has just stopped the price dropping. Very nice. Pretty nice. Into the top edge, not much of a sell here. Starting to build a sell here, see it? See the difference? This time we get red at the very top edge, which means that that is a stronger suggestion for a sell. We've also got 5 solid short trades lining up beside each other there. That's a good max sell. Do you see that? It's a good max sell trade right there. The red at the bottom helps you with the sell as well. There's no way we could buy, excuse me, there's no way we could buy that. And because the second box is, the top box is red, that's an aggressive sell, not a passive sell. If the top box is, if the top box is green, it's a passive sell, not an aggressive sell. If the top box is red, it's an aggressive sell. So we cross in to get that sell just there at 57s. It's dropped down to 54.5. The sell has worked out beautifully. Into the bottom edge, you can see we're starting to build a little bit of a case here, but we're not really getting a lot of signals. So there is another case building here for a possible, but it is going to be still, because you can see the top line is red. If it's going to be a buy trade, it's going to be a very passive buy trade. But it's at the moment, I'm not really getting enough. You can see it's definitely getting a passive buy trade, but you can see that it's still dropping down. That's okay. We're letting it drop down. We're not going to try and bid against it, because as I said, it's a passive buy trade, not an aggressive buy trade, a passive buy trade. So you don't do anything with that trade at this stage. There's not enough signal. There should be at least a red at the top edge. There should be something in this area. There should be either a solid, like in here, there was a solid green band before the buy came in. There is nothing in here to tell me to buy this just yet. Nothing yet to tell me to buy it. So we'll let it go through. We let it drop through. We are not interested in buying it just yet. And that was a good decision, because take a look at what happened. It's just dropped again down into the bottom edges. It's just dropped into the bottom edges here. See how nice that was? So we've managed to hold on to our short sell at 57s. It's now traded 50s. That is a 7-point profit. That's $350. $350 of profit, downside profit there, guys. That is a very, very good trade outcome, isn't it? Very good trade outcome. So congratulations if you decided to play along.